Okay, I think that we're good to go.
Yeah, let's get this party started, shall we? So welcome everyone to this webinar about savings. My name is Henrik Kastwall, and I'm basically just here to introduce my colleague, Felicia Schön, our private savings economist, or whatever the proper title is. And most of you who are listening in today probably have your occupational pension at Avanza. But this session will not be mainly about pensions, but more about savings in general, which is why we have invited Felicia to speak more about this. So without further ado.
Thank you, Henrik. Thank you. Very nice introduction. So now you will have to stick with me for the next hour, and I'm super excited about that. We're gonna talk about savings and how you save the best, up your savings. And as Henrik said, my name is Felicia Schön, and I'm a private economist, and that means that my job actually is to educate our customers and the Swedes and everyone who wants to listen about savings and investments. So I have a very, very fun job. But let's get into it because we have an agenda today. We're going to talk about savings account versus stock market. When are you going to choose one or the other? And then we're going to talk about a bit about savings accounts and what you should think about when you pick a savings account. And also short-term saving goals. But we're also going to talk about the stock market and the investing in stocks and funds. Should I choose stocks or should I choose funds? We will talk about how you choose funds, but we won't talk that much about stocks today, simply because we don't have the time. But if there's interest in learning more about stocks, then of course we can have a webinar about that, perhaps during the fall. And then I'm going to show you a bit about how Avanza's customers do it, their savings. That's always interesting. So let's get into it. And I'm also going to say that we have a Q&A. So you're welcome to write there if you have any questions. We have a team that will try to answer some of the questions. And then we will have a Q&A in the end of this webinar. I'm also going to say this is a risk text, a disclaimer. Not anything or nothing that we say today is a recommendation on what to buy or what to sell or anything like that. It's very important to do your own analysis. And I'm also going to tell you guys that it's a risk. Investing is a risk. Historically, it's been a very successful way of making your money grow, but no one knows what's going to happen tomorrow. So be careful out there. And it's super important to be aware of the risks. And we're going to talk a bit about risk as well. But let's start with the savings account versus the stock market. So the thing with this is that, or the whole thing is it a short-term savings goal or is it a long-term saving goal? So if it's a short-term, and short-term is if it's 4 to 5 years or less. If you're going to save in 4 to 5 years or less, it's a short-term goal. And if it's more than 4 to 5 years, it's a long-term goal. And then you should choose the stock market. And if it's a short-term, then it's a savings account. And why is that? We have a graph here, diagram here, where you can see that the blue line is if you invest in the stock market, 10,000 crowns a year with a 7% return, which you can count. That's what we count that the stock market is giving us a return in average. In comparison to the savings account with an interest rate of 2%. The difference, if it's a long term, it's huge. So that is why it's very important to give your long-term savings the opportunity to actually grow. And it's also important to think about the fact that if you save long term on your savings account, the inflation is going to decrease the value of your money. It's not going to do the money will be the same, but it will be worth less. But the stock market is very high risk if you have it on short term. So that is why savings account, short term, long term, stock market. All good? So let's start with the savings account. In Sweden, we have interest rate right now. The interest rate right now is 4%, which means that you should demand that your savings account have interest rate of at least 3 to 3.5% right now. So it's very important, and it's the perfect place for your short-term investments, such as your emergency fund. Everyone should have an emergency fund. It should be the #1 savings goal. Travels, if you want to buy an apartment within the next few years, renovation, what do I know? Anything that you want to save short term, the savings account is a great place for that. And at Avanza, we have our own savings account, which currently has an interest rate of 3.5%. But we also have collaboration savings accounts, which we called Sparkonto Plus, Savings Plus, which currently the highest interest rate is 3.75. So I would say that that's a very decent interest rate right now. So you could also, on this savings account, you can choose if you want to have it fixed or unfixed. And that means that if it's fixed, then you can't take out the money. Then you have to save it during some time, the time that you lock it in. It might be 3 months or 6 months or 1 year or 2 years. Then you should be absolutely sure that you don't need that money during that time if you have it fixed. Otherwise, I would have it unfixed. And you should also make sure that it has a deposit guarantee. And at Avanza, every account has a deposit guarantee, so you don't have to worry about that here, but there might be other actors. Let's see. I think we have a hand raised. Is there anything that is important right now, or can I go move on? Okay, let's move on to the stock market, because that is the most important, not the most important, but the most interesting thing. So I would say that one of the biggest mistakes or the biggest risks in your long-term investments is to not be on the stock market. And that is due to what I talked about earlier, that gives you your money the opportunity to grow. So what you can see here in this picture is the compound interest rate that grows exponentially over time. So this is really important if you have a long-term investment, because that makes your money grow. In this picture right here, you can see that the blue line is the total amount that you will have after a certain amount of years, and the green is the return solely. So it's a huge difference. In this one, we actually counted with a 10% yearly return. That is quite high, but it's just to give you an example. But the thing about it is that if you get interest rate, let's say that you get 10% interest rate and you have 1,000 crowns. After a year, you have 1,100 crowns. Then year 2, you will get 10% of 1,100 crowns, and so forth. So it will, when you get interest rate on your interest rate, that is when you get the compound interest. So very important. I think that Albert Einstein called it the eighth wonder of the world. So that is how powerful it is. But let's take first things first. Account choice. It is a jungle, I know. But in Sweden, we have something called investment savings account, which usually is just ISK. And this is a very popular and simple account to use because you don't have to think about doing your taxes on it. It just, everything is just automatic. And the tax is quite low. It's 1.09% of the average value of your account during the year. So the actual calculation of the tax is quite complicated. But I would say that if you think about the value of your account and that tax is 1.09% of that, you will get a pretty close enough idea about what the tax will be. So this is, I would say that 9 out of 10 customers have this account for their investments. But we also have 2 other accounts that could be very good to know about, and it's the capital insurance. The tax is about the same as the investment savings account, so it's quite low and everything is automatic and so forth. This is very popular if you save for your kids or your children, because then you can put your children as a beneficial förmånstagare, vad heter det? Beneficiary. So that if something happens to you, your kids will get the money, but you can decide when your children will get the money. Because if you save for your kids in their name, they will get the money when they're 18, and many 18-year-olds might not be mature enough to get a large amount of money at that age. So it's very, very popular for savings for your kids. It's also very good account if you want to invest in stocks outside of Sweden, and especially if they give you dividends, and it's due to tax reasons. So good to know. We also have the traditional account called stocks and funds account, called aktie- och fondkonto in Swedish. This is like the basic account. Everyone will have to have one if you're a customer here at Avanza, but you can choose not to use it, because if you do, then you have to declare your taxes by yourself. And the tax is 30% of the earnings that you've made when you sell. So it depends a bit on when and where you save and how you invest. But I would say that investment savings account and capital insurance is the way to go for most people. But of course, you can choose by yourself. So I think now we have this cleared out. Let's go into the investments. So when you invest, I would say that there's 3 rules that you should always, always, always have in the back of your mind. And it is that it is important to be long-term. I'm nagging you about this now, but it is important to be long-term and to have patience. If you think, oh, I'm gonna be rich fast, gonna double my my savings, I think you will be disappointed. It's better to save regularly and be patient. So another important thing is to have a very good risk diversification, which means that you don't put all the eggs in the same basket. I'm going to go into this more in a bit, but it's very important to have a large amount of different stocks and funds and so forth to lower the risk in your investments. And that is called diversification. I think there's another word for that. It might be risk diverse. Never mind. Risk diversification. Let's get into that. But it's also very important, the last rule, aim to save consistently or on a regular basis. And in Sweden, we call this månadssparande, monthly savings. Every month when you get your salary, you invest and save in funds or stocks or on your savings account. Because if you do this regularly, and if you have a good risk diversification, and if you are long-term, then I'm not going to guarantee, I'm not going to promise, but it will higher the probability of you to actually be successful on the stock market. So 3 rules, remember them, always have them in the back of your mind. This is a graph of the Swedish stock market from 2002 until now. And as you can see, the stock market doesn't move like this. Is it like this for you guys? I don't know if it's mirrored, but the thing is that it doesn't move constantly like this. It has a bit of like this. And that means that, oh yes, we say that you get a return of 7% yearly, but it's not 7% every year. It's 7% in average, which means that some years the stock market might give you 30%, some years it might be 3%, some years it might be minus 10%, but if you keep your investments during a long period of time, historically, the trend has always been positive. So that means that if you say that you started saving in 2015, when you can see a little bit of a mountain in this graph. Yes, next year you might have lost money. But if you keep it for 2 more years, then it's all coming back even more. So that is why it's so important to actually save regularly and be patient. And I'm going to show you another graph. This is a graph that shows risk on the y-axis and y-axis, right?
Yeah.
Yeah. And the amount of shares or stocks or companies that you have on the x-axis. So if you want to lower your risk, the more companies you have, the less risk you have. So the green line here is the company specific risk, which you can diversify through risk management. And the pink line is what we call the market risk. And the market risk will always be a risk that is when you do your investment. You cannot diversify the risk, the market risk. And that is why it's always a risk to be in the market, even though you have a good diversification. So let's say that we get a world war or global inflation like we had right now. That is a market risk. That is a risk that is in every kind of sector, in every country. So even though you have stocks in all of the world, you will be exposed to this risk. But you can lower the risk by owning many companies. So that's a bit about risk. Let's move on to stocks and funds. It's very hard for me to know exactly how much you know about funds and stocks, so I'm just gonna do a little bit of a basics here. A stock, that is the ownership in a company. You buy a little bit of that company, which means when you buy a stock, it's an investment in that company. You want to be a part of the company so that you can benefit from the earnings or if the company is performing well. When you buy stock, there's something called a brokerage fee, which is the fee that you pay for doing your transactions. What that fee is depends on what kind of stocks you buy, how much you buy, and so forth. But we have a price list on our site. It's very high risk to own an individual stock because, you know, if you own a company and something happens to that company, then you might lose the whole value of your stock. But if you own 10 companies and only one company is performing not as expected, then you still have the majority of your investment still there. So very important, do not own a single company. So an important rule. The thing about stocks is that it requires more time from you. You have to keep track on them. You have to analyze them, what kind of news has come from the company and so forth to be able to determine if it's an investment that you want to keep on doing, and if it's the stock is well worth your money and so forth. So that is why funds is so good and it's so popular. Because fund is a collection of many stocks, which means that you get the risk diversification, but also that you don't have to analyze the stocks yourself. So it's a very popular way of investments, do your investments in Sweden. And I should also tell you this, that I know that abroad it's very common to invest in something called exchange traded funds. In Sweden, it's more common to invest in something called mutual funds, which is not directly bought in the stock market, but it's more of like it's a mutual. I don't really know how to explain it, but it's a bit of a difference, but you still get all the stocks that the fund has invested in. So when you buy funds, there's something called a fund fee, and the fund fee is a yearly percentage that you pay for the fund, and it's automatically drawn from your account, so you don't have to think about it. But it's very, very good to be aware of it. And we're gonna talk more about funds now because funds, I love funds. Everyone can invest in funds.
Sorry, just to clarify with the questions, there are some people who are raising their hands. We just want to clarify that you will not be able to verbally ask your questions, but instead type them down and write them in the chat, and we have a team that will answer them for you. And then we will, of course, save a couple of questions for you to answer in the end. Sorry for the interruption.
That is totally fine. Sorry if you guys have a lot of questions, but we will try to answer them all in the chat and later. So let's talk a bit about funds. So there's very many different funds. And there's something called passive funds. We also call them index funds. And that is a fund that invests in holdings that are mirroring a predefined index. It could be the Stockholm stock market or the American stock market, or it could be the Dutch stock market. There's so many different indexes, but it's a passive fund. And since it's passive and you only follow the stocks that are in this kind of index, then it's usually a bit cheaper to invest in these kind of funds. Because we also have something called actively managed funds, and then that is when you have a fund manager who is actually picking out the investments that they do in the fund. So since they're doing stock picking and analyzing the investments, it's a bit more expensive to invest in those kind of funds. The fund fee is usually higher, but it also, or in some cases, the return also might be higher, which then makes it appropriate to have a higher fee. So that is like the two main categories of funds that we have on our website. But we also have different kinds of funds where they have, sorry, I'm just gonna have to ask about begrepp här. Innehav.
Position? Yeah, positions.
Because the funds can have different positions. It might be stocks, but it can also be bonds. Allocation might be a word. I just there's a word here that I can't kind of come up with, but let's work around it. So let's move on to this middle part here, where we have the stock funds, and that is when the fund invests in stocks, which is perhaps the most common way of invest in funds here at Avanza. But there's also something called bond fund or fixed income fund when you invest in different kind of bonds and interest rates. That is usually a bit lower risk in those funds, but also a bit of lower expected return in those funds. It might be appropriate for shorter investments, but I'm going to talk a bit more about that in a sec. There's also something called mixed funds, and that is when you have a mix of fixed income and stocks. And you do that because you want to lower the risk in the fund. I know that the ones that are occupational that have occupational pension here at Avanza, you get a fund called Avanza 75, and that is a mixed fund where you have approximately 70% stock market and 30% fixed income to lower the risk in the investment. And we also have a fund called special fund, and that is usually when the fund invests in other funds. So that is good to know about it. So stock funds are usually considered to be a bit more high risk, but high risk in this case is also connected to give a higher return. So if you have a long-term investment, the risk is much lower. I'm gonna show you a picture here. I'm sorry that this is in Swedish, but I'm gonna translate it for you. You have the high risk on the red area here and the low risk on the green area. And you have the short-term fixed income funds is the lowest risk. And then you have the long-term fixed income funds, which is a bit higher risk. And then you have the mixed funds, and then you have the stock funds. So this is the risk allocation of these different funds. And then I would say to the right of the stock funds, you have individual stocks. So you kind of get an idea of the risk here. But as I said, that lower risk is usually connected to have a lower return as well. So this is this picture right here is our automatic fund allocation called Avanza Auto. It has 6 different risk levels, where the dark green one is the highest risk, and the is it yellow or is it orange? The orange one is the lowest risk. So the highest has mainly stocks, and the lowest has mainly fixed income. As you can see here on this 5-year graph, is that number 6, yes, it has more turns up and down, but the return is also higher in comparison to the one with lower risk that has a lower return, but also fewer of these kind of mountains and valleys. So that is very good to know. You can also see here during the pandemic in March 2020, you can see that the high risk fund has much more of a steep decrease in its value, whilst Avanza Auto 1 had a much kind of like smooth reduce in its value. So, but it also, Avanza Auto 6 came back much faster. So yes, the value will dance a bit more up and down, but it will in the long term expect to give you a larger return. So that is why the risk and the time frame is very much connected. So let's move on. We talked a bit about fund fees a while ago, and we have a general recommendation. And if you invest in an index fund, a passive index fund, the fee should be below 0.3% yearly. It shouldn't be more expensive than that, because then you can get the exact same investment cheaper. And why would you pay more for the same investment? Doesn't make sense. But if you invest in an actively managed fund, the price is usually higher. And I usually say that below 1.5%, you can find very good actively managed funds, but they can cost 2%. And it doesn't have to be bad or something that you should avoid, but you should just be aware of the fund fee, and that if you pay more, then you should also expect that you get a higher return than the index fund, because otherwise you just pay more to get less. And who wants to do that? So I'm gonna show you another graph here, and what we're looking at here is the fund fee over time. So if you choose a fund that has over 0.7 in fund fee, it's the green one, and compare it to a fund that has over 0.2 in fund fee yearly, over 40 years, you will have paid 500,000 crowns in fund fees if you have 0.7, and just below 200,000 if you pay 0.2. But this is, of course, if they perform exactly the same. So this is perhaps for an index fund. If you are choosing between two different index funds that are following the same index, and one is 0.7 and one is 0.2, this is what you will end up with. But of course, if you pay 0.7 for an actively managed fund that also gives you 1,000% more in return, then it could be okay to have that kind of fund. But I just want you to be aware of the fund fee and how it affects your investments. So let's talk about sorry. Let's talk about allocation, or how you will choose your funds and how you will distribute them. So here the goal is to spread your risk and diversify your portfolio. So I would say that you will start with choosing what kind of risk level you want. It's called risknivå in Swedish, risk level. So usually we say if you have a 10-year time frame, then you can have a 100% stocks. But for every year less that you are investing, you should put in the equal amount of fixed income. So say that you will want to invest for 7 years, then you might have 70% stocks and 30% fixed income. That is the rule of thumb. So let's say for your pension, when you have 40 years until you are going to retire, then of course 100% stocks is the way to go. If you're fine with the risk level, of course. When you've chosen your risk level, then you are going to choose your distribution of your funds. And in this circle right here, I have 40% investments in Sweden, and I have 40% investments globally, and I have 20% of what we call krydda, spice. The little extra that you put in your portfolio that can give you that extra boost. Or if you're interested in something, it might be that you're interested in real estate, or that you are interested in artificial intelligence. So this is just an example of how you can think if you have perhaps 100% stocks for your pension, for your children, for your future dream. And here is more of a in detail picture of how you can do it. So let's say that you want to have a fund portfolio, and I would say that pick around 3 to at least 3 to 6 different funds. But of course you can have 3 and you can have 10. I have 12. So it's totally up to you, but at least 3. And the base of your funds should be the passive index funds, like a global index fund and a Swedish index fund, or if you want to have a European index fund, you don't have to have a Swedish index fund. But these kind of funds, they're very broad, so you get a good diversification straight away, and you will follow the world's return. So they are usually always good to have and perform well over a long period of time, and they're cheap. Cheap. But then also, of course, investment should be fun. So we want to have the spice in our portfolio. And that is when you perhaps choose the real estate or the artificial intelligence, or if you're interested in the impact funds or whatever it might be. So choose 1 to 3 different kind of index funds, and then spice it up with your your chose of chosen of funds. So I think that is very clear, hopefully. But it's kind of like choosing your kind of candy for the weekend. Do I want chocolate or licorice, or do I want sour or sweet? To put it together as a nice kind of like, this is what I believe in, this is what I want, this is what I think will give me return and satisfaction. So, and as I said, this is just a suggestion. You don't have to do it like this, but now I know that you guys are like, okay, but how? How do I know which fund to choose? We have 1,300 different funds to choose from, and I know it can be challenging. So I'm gonna give you some tools here. First of all, we have the complete fund list, and that is where you can choose kind of what kind of, you can filter on this. What kind of fund do I want? Do I want it to be a stock fund? Do I want it to be a fixed income fund? Do I want it to be mixed? You can also choose what kind of region you want to invest in, globally, Sweden, Europe, Japan, whatever you prefer. But here you can also choose what kind of fee you would like, if you feel that it's important for it to be sustainable, and so forth. So that is like the entire list. We also have something called Morningstar stars. And these stars, the more stars the fund have, the better the fund has performed in relation to other funds in the same category historically. And it's also kind of like how well has the fund performed in relation to the risk that the fund has. So that could be one way of finding good funds. But of course, even though they performed well historically, we don't know what happens tomorrow. So be aware of that. One tool that I usually use is the historical comparison. And that is when you say that you have 5 different global funds and you're like, oh, which one am I gonna choose? Then I go into the fund, look at the graph, and then put in the 5 other funds that I'm looking at. And then I can see how they performed in comparison to one another. And I can also see how well they performed during a crisis. Did they manage well or not? So that is high recommendation for me to do that kind of comparison. And it's very educational as well. And lastly, we have the Avanza Smart Fund tools. And I'm going to talk a bit more about these 3. Avanza Auto, Portfolio, Generator, and Fund Inspiration. So if we look at this, we have the Avanza Auto. I talked about this earlier when I compared the different risks. This is the fund for you who wants everything to just be totally automatic. Because in this fund, or in this fund tool, you can choose how long am I going to save, which risk am I willing to take from 1 to 6, and how much do I want to save monthly. And then it's all set. And this is also one of those funds where you only need one fund. Then you don't have to pick 3 different ones. Then it's totally okay to just have one, because this is it's automatically rebalanced for your risk level. So it's totally okay to just have one fund there if you want to. Then we have the portfolio generator, and this is the picture that you see here. Sorry again that it's in Swedish. In this one, you kind of answer some questions on what time frame you have, what risk you are willing to take, and then you get a suggestion of a portfolio that could be allocated with Sweden or globally, and then you can kind of like adjust it if you want more global and less Sweden, and so forth. And then you get suggestions on funds that is in that kind of allocation. But you can also switch them out if you have some favorites or so forth. So there's also high recommendation to try that one. And then lastly, if you you want to do it all by yourself, you just want to pick your own fund portfolio, then we have the fund inspiration list where you can find different categories. Do I want it to be an index fund? Do I want it to be actively managed? Do I want it to follow some specific market? So then you can just do it all by yourself. And this is all on our site. And I know that we have some difficulties with the language on our site, but use Google Translate, except for on Avanza Auto that would translate to Avanza Car. It is not a car, I promise you. It's a fun, but try that one, and I think you will find your way. I just want to inform you that we have a tool called the Fund Portfolio Analysis. So if you want to kind of take if you want to know what your portfolio looks like and how diversified it is and what kind of fee it has, then you can go to Min Ekonomi and then to Analys. And then you will find this where you can see what kind of regions you invest in, what kind of sector that your funds are in, what fee you have, the average rating, the average risk, and so forth. This is not my portfolio. Just want to disclaim that. This is just an example, but it's really good. So use it. And then lastly, I think we're on the last slide now. This is how our customers invest as per right now. So the monthly investment is overall 3,100 crowns monthly. And as you can see, women tend to save much less than men. I think the savings gap is about 28%. So girls out there, try to save more if you can. We don't want to be overrun by the men. We want to be equal. But you can also see that the allocation of the savings is that our customers tend to pick stocks, but that is also because our customer base is very interested in the stock market. So 50% stocks, 33% funds, but we also have 13% that is in cash, and 4% that is other securities such as certificates. It might be exchange traded funds and so forth. And these are also the list of the most common funds to invest in monthly. And if I'm gonna translate not the name of it, but what they are, the type of fund, the number one fund is a Swedish index fund that follows investment companies. The second fund is also a Swedish index fund that follows the largest company on the Stockholm Stock Exchange. The third one is the global index fund. Also, the fourth one is a global index fund, and the fifth one is also a global fund. I know that one is actively managed though. Avanza Auto 6, we talked about that. And then we have some more American and global funds as well. So that is basically how our customers tend to invest. And I would say that they follow our tips kind of well. They like global index funds, and global index funds are great. So can't go wrong with that if you have a long-term savings goal. So my best advice, invest monthly. If you have a monthly saving, it will really, really, really up your savings, because then you get all the free golden rules. You will have the long term. You will have the risk diversification if you pick a fund portfolio, and then you will also do it regularly. So that is really good. As you can see here, you have, during a long period of time, monthly investments can do a lot for you. So the rule of thumb, 10% of your salary after taxes, monthly savings. And then if you choose to have, say that you actually save 2,000 crowns a month, then perhaps you can put 1,000 crowns into the stock market and 1,000 crowns into your savings account. So you can do both. Doesn't have to be one or another. But I would say that's all from me. So now we will have a bit of questions. And right, if you're interested in learning more, then you can follow me on different social medias. And you can also contact me at this email right here if you have any questions. I don't promise that I'm that fast at answering, but I always answer. So,
Right.
have we gotten any questions?
Yes, we got quite a lot of questions, which is great and fun. Thanks everyone for your really good and relevant questions. And now I'm just gonna find all your good and relevant questions. I had them in front of me, but now I lost them. There we go, back on track. So starting off, we got a question regarding the different types of accounts. And the question was when it's more beneficial to use what we call AF, aktiefondkonto, or regular depot account compared to an ISK. When is it beneficial and when is it not? When could, for an example, an AF account be more beneficial?
This is a really good question, and it's kind of hard to answer as well because it's so many ifs and buts. But I would say that in general, if you have funds that are more lower risk, so they expect to give you a return that is lower than the schablonintäkt, which is currently 3.62%, then it could be more beneficial to actually use the traditional AF account if you look at the taxes. So, but then you should be aware that you have to declare it yourself, and that could be a bit tricky. So if you have stocks, I would say that ISK is more beneficial for most people. There might be expectations, undantag. Exceptions, thank you. Do we have any more questions?
Yes, we do have. In fact, going back to saving for kids.
Yes.
I think someone wanted some more clarifications, especially we have what we call KF barn, so KF children saving. What is the difference between a regular KF and KF savings or child savings?
It is that you can put a beneficiary on the. Please correct me if I'm wrong here.
Basically, straight away when you open the account.
Yes, when you open the account, and if you open it called KF Children or Kapitalförsäkring Barn, then you can put your children as a beneficiary straight away, so that the money is actually your children's money if something happens to you. So
right, so basically you save yourself one step compared to when you open a regular KF account.
Exactly, because then you have to put in the child as a beneficiary in another step.
Yeah, and also the question was regarding when or when not the child receives the money invested. But if you open up on KF child savings, of course, then you save in your own name, but you can, whenever you want, transfer it to your children after they turn 18, so they will not receive it straight away.
Exactly.
When they turn 18, is that correct?
Exactly. So with a kapitalförsäkring, capital insurance, then you can choose when your child will receive the savings that you have made for them, which is, I really recommend that because not all 18-year-old are mature enough to actually handle their savings, and it might be that you want to give it to them when they are 25 and they want to buy I don't know, an apartment. So then you can choose more when they will receive the money.
Yeah, I'm a good example of that. I went to a music festival called Peace and Love with my savings.
Yeah.
Yeah. So
I didn't get any. I got a lot of other things instead, but
as compared to an ISK, for example, that you open up in the child's name, so as soon as they turn 18.
Exactly, and you can't do anything about it. Let's say that you save 1,000 crowns monthly for your children, and when they turn 18, there might be 200,000 or 500,000 on that account, depending on the return, which means that the children will get the money, and you can do nothing about it because it is the children's money. So you can't take them out, you can't force them to do anything about it. So bear that in mind. That is one huge mistake for many parents.
Yeah, definitely. So another question, which I thought was really, really good, is what is the trade-off between investing in a mutual fund and investing in an investment holding firm such as Berkshire or Investor, for example?
I would say that the largest difference is that when you pick a fund, there's usually more companies and stocks in it. Also, when you choose an investment company like Berkshire, they are usually much more invested in the whole company. They perhaps are there to make decisions, and they kind of have another connection to the company, which makes it harder to perhaps switch them out and so forth. Which doesn't have to be something that is bad.
That could be a good thing.
That could be a good thing, absolutely. But I would say that is the largest difference. But the largest is the fact that a regular mutual fund usually have more companies in it.
Yeah.
But they're similar. So if you want to start with some kind of stock, then investment companies usually are a very good start. And we have a lot of them in Sweden.
Yeah.
And they perform pretty well as well. So, or have performed. I don't know about the future.
No one knows about
disclaimer. Yeah.
Great. And we have another question. This is probably more towards pension and how one should think. What are some milestones to think about in terms of reallocating risk as you progress towards retirement age? So should you switch to holding a more fixed income investments or more equity investments to avoid the risk of having your retirement savings go disappear overnight?
This is a really good question, and also a regular or common mistake that you kind of take the risk down in your portfolio way too soon. So say that you're 60 years and that you will retire at 65, then you won't use all your money at 65. You are going to use them within a time span of perhaps 20 or 30 years. So I would say that think about the money that you need the next coming 5 years, and that money you can have in a lower kind of risk, a fixed income or a savings account. So you're always thinking like 5 year kind of like blocks. So that is my best tips.
5-year plan.
5-year plan.
That is completely different thing, but yeah, a benchmark. Oh, sorry, I'm thinking about Soviet economy.
But I'm also thinking on that question. That it's very common also that you think that you will always only be alive until like you're 85, but you might be 95.
Yeah.
So think about that as well, and don't overrate.
Yeah, and I think you're completely right with regarding that you will not access your whole pension capital as soon as you turn 65. You will
exactly, and you want to give the rest of your capital the opportunity to grow.
Yes.
So, 5-year plan.
5-year plan. We have one more question. Here we go. How should one think about market diversification? To explain further, how to make sure we can invest in markets that will grow in the next 10 to 20 years and reduce home market bias?
Oh, good question.
Really good question.
It is difficult with home bias. I know Swedes really like the Stockholm stock market, for example. But it might be a bad thing, but it can also be a good thing. Like if you look at the American stock market, Americans that has invested in the American stock market has gotten a really good return. But I would say, of course, when it comes to market, try to have a good diversification there as well. Even though that you like your own companies, perhaps the Italians like Ferrari and so forth, but try to think about the pie chart so you have a diverse. I think that your home bias should not be more than 50% of your portfolio. But the thing about home bias is that you usually understand the market that you live in much better than other markets. So it's easier for you to do your analysis of how the market will perform in the future and what kind of affects it. So it can be easier for you, but try not to have more than half of your portfolio in your home country, I would say.
Yeah, so in some some cases might be an upside because you have more information available to you and easier to access it.
Of course,
possibly.
I know the Swedish market better than any other market, and I understand the companies here much better than I understand French companies. But that doesn't mean that French companies are bad. It just means that I have a better understanding of the Swedish companies, which makes my investments easier in Sweden. But of course, things can happen in Sweden that in that case will affect a very large part of my portfolio. So that is a risk, and the risk should be managed, not avoided.
Wise words. And that is basically the questions we had for today.
Thank you guys so much, and thank you for sticking with me and my stumbling in English. But I think we got I think we got it all out.
Yeah, we did a good job. Well done, in my opinion. I haven't done anything.
Job.
You did a good job. I have been sitting there.
But thank you guys so much, and please don't hesitate to contact us if you have any questions.
Have a good day.
Have a good day. A good Friday. I'm going to Italy.
Yeah, lucky you.
It's lucky me.